Tom Lee, everybody's favorite bull. Tom Lee went on CNBC, made some pretty big predictions here today, just a few hours ago, about where this market's going. I got the full clip here. I want to go ahead and react to it. I know usually on YouTube, sometimes they only put out like a small clip of what he says. We're going to get into it all. So that's all we're doing in this one here today, folks. Reacting to this, sharing my opinions and perspectives on this one. Appreciate you joining me. All I need from you guys, smash that thumbs up button. Additionally, if you want to subscribe here to the channel, you can certainly subscribe. 85,000 plus subscribers strong. So appreciate y'all for being here. Looking to apply, join our private stock group. Pin comment down there. Click on that, fill out a form. Let's get into this.
It's good to have you. What do you make of this report? I mean, part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist, maybe an olive branch. What do you make of it?
Well, I think markets should interpret it positively, because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses. And I think it would set the stage for a much bigger recovery rally than we expect.
If you're confused on what they're talking about, this particular part right here, essentially this is in regards to Trump and what happened today. So essentially Trump came out today, and his tonality in regards to China and maybe trying to work out a deal in regards to tariffs sounded definitely more open. And so that's what they're addressing here. And so Tom Lee, everybody has kind of taken a worst case scenario in regards to the whole tariff situation. And so, if he can get a little bit better, that matters meaningfully for the market.
Right.
Yes,
I mean, the problem is the paralysis, if you will, between now and then. Like, what are we supposed to do over the next 10 days?
That's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom, or have historically bottomed, before the event actually happens. The best example is the Cuban Missile Crisis, 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? I mean, listen to Nike, FedEx, put that on top of what we've already heard. Are you concerned about where the economy's going?
It's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
I mean, it depends, to what degree consumers remain skittish. CEOs are paralyzed in their own right because they can't really make any moves because they're not sure what's going to happen, and ultimately whether a growth scare spirals into something else, which Jeffrey Gundlach gave me his view yesterday right here on Closing Bell. Listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
50, 60%? I mean, if he's right, what does that mean for the stock market? Way too expensive.
Well, the S&P had a 10% drawdown. That's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. And
I'm sorry, finish your thought.
But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the market
weakness.
the real economy?
So, okay, there was a lot there, right? I want to address 2 points. One is, don't be surprised if markets bottom around April 2nd or before April 2nd, right? Maybe right here at the end of March, and then start moving up from there. People find out April 2nd is not as scary as it is. But let me explain a much bigger thing in regards to stock market and how silly this is, right? Because he says, it's not priced in about recession. Like, true, but on the flip side, think about how silly this is. Let's think about this for a moment. The market gets all freaked out, recession. What do we know about recessions? They're here today, gone tomorrow, right? Every recession, last 100 years, look back, they're here today, gone tomorrow, right? Like look back the last 40 years, 50 years, right? Boom, and then they're gone. So, and then especially in the modern financial times of the last 20 years. So the market gets all freaked out over a recession. It's a short-term thing. The market should ultimately be doing what? It should be pricing where the economy is long-term, where company earnings are long-term, right? Because that's what matters. So the market has this bout of volatility because of recession fears, and sometimes you get it, sometimes you don't. But it's all silly. Recessions don't last. They're there, and then they're gone. And what's left is the long-term prospects for the economy, the long-term prospects of companies, which are very, very positive. And so that's why they're always just great buying opportunities. You got to take advantage out there. And to get all caught up into the short-term this or that, it's very, very silly. And it's a very bad thing to do financially. I can tell you that much.
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence.
What about the idea that Gundlach also put forth that in his words, unintended consequences of all of the rhetoric from the president is making people think twice, especially overseas, about investing in the U.S., and the view that Europe is just a better value and offers even less risk than before? How do you play that?
We hear a lot of folks talking about that, but as you know, Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. One of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again.
I want you to stick around. Those warnings from Nike and FedEx doing little to quell fears, as we're just talking about, of a slowing economy. Fed officials weighing in today on that outlook as well. That's why we'll bring in Steve Leisman, our senior economics correspondent. I guess I would look at these additional warnings, if you will, Steve, from the likes of Nike and FedEx, and go back to midweek and the Fed chair, when he basically said, look, surveys are one thing, actions are another. So if they're somewhat dismissive of the surveys, which have shown consumer weakness, do they pay attention more to actual CEO commentary?
I think that's a part of it, Scott. I think what they're looking for is the extent to which the soft data in Fed speak bleeds into or ends up affecting the hard data. And
the soft data, what he's talking about there, hard data meaning essentially like, actual unemployment numbers or jobless claims, those sorts of things. Soft data means like confidence surveys, those sorts of things, just so everybody's aware. And by the way, you might ask me, why do I not get freaked out? A lot of, newbie investors get freaked out over like, recession, it's coming, I should sell out of my portfolio and things like that. I don't get freaked out because I'm thinking about the next several years. And so in regards to recessions, like no one knows where the bottom is. So to try to time it out and get out of the market and then try to get back in, it's a silly game to play in the end. So for me, I'm thinking about where the economy is a few years from now. I'm thinking about where company earnings are a few years from now. So, a recession is usually a few quarters, and then it's over. And so that doesn't faze me at all because I'm worried about where things are at 3 years out, 5 years out, 7 years out from now, right? And that's the way you got to think as a long-term investor. So you look past recessions and honestly, recession fears. You know how many recessions have been predicted just in the last 16 years being in the market? I think I've heard about recession predictions every single year since I got in the stock market back in 08, 09. Every year coming out of that, then they're worried about double dip recession. Every year out about, now we're going to go back into recession. We're going to have a recession. It's been a long time since we had a recession. We're due. Recession's coming. Every year, 1,000 people are predicting recession, right? Sometimes you get them, sometimes you don't. At the end of the day, it's just short-term volatility in the market. You take advantage, you buy and buy and buy.
Data are those sentiments. And we've seen situations, and Powell talked about this, I've written quite extensively about this, where people get depressed and the sentiment is down, but they end up spending. And it depends on the price that's out there. That's a big part of it. So it hasn't really necessarily happened yet. But these comments from CEOs that suggest it should or could show up in the hard data. You talked about Goolsbee said, we just need more time to figure this out. It was a big part of what he said today, Scott. And just don't you can't expect the Fed to say right now that what we're going to do later on. He said he's seen a decided turn in anxiety, and that's, by the way, including just businesses and consumers. But the Fed's just going to have to wait through this bumpy patch. That was essentially the message of Goolsbee today.
What do you make of what Gundlach told me yesterday? 50 to 60% chance in his mind that we're going to have a recession.
You know, this is what everybody is doing, and probably nobody does it better than Jeff, which is you have two potential outcomes, and you need to put probabilities on those outcomes, and those probabilities will be the ones that instruct your investment, right? So I am listening carefully to every Fed official to hear which part of the mandate are they more concerned about, the growth side or the inflation side. I think maybe the reason why the market took some heart from what Powell said on Wednesday was they heard him siding or being more concerned about the growth side. I don't know if you remember the question I asked him. I said, what do you do when you have lower growth forecast and a higher inflation forecast? And well, we look at how far each one is from the mandate, and then we see which way the outlook suggests they're both going. What I'm hearing, and this is not definitive because they've not made up their mind yet, Scott, a little more concern about the growth side, and that 50% probability from Gundlach, maybe it's a little higher than the average Fed official and on the street, but it's within 10 or 20 points.
No, I think you're exactly right to focus on that. And I mean, I thought that the way that our colleague Mike Santoli gave his view of the Fed meeting and Powell's commentary as well played into that. An acknowledgement, at least softly, that they're willing to tolerate a little bit higher inflation, but they're not willing to tolerate a labor market deteriorating in any significant way, especially after the job they think they've done in holding it together.
Yeah, so that's really the rub right there, is what is their tolerance for higher inflation? And so that's why you listen to, and that's why I do it, Scott, so the average viewer at home doesn't have to. Listen to what they say about inflation expectations and the extent to which they believe those medium and longer term expectations are anchored. Williams talked today about the Michigan index. He thinks that's a bit of an outlier. He likes his own index, which shows that they're a little bit more contained. You look at the market surveys of inflation expectations, they're a little bit more contained. So if you put it all together, you say, yeah, the Fed is going to tolerate, especially if they believe the tariffs are going to end up in these one-time price hikes and not bleed into the broader indices. So you just got to listen, Scott. You just got to take in everything they're saying and do what Gundlach is doing and everybody else I talk to, which is put probabilities on these two potential outcomes. And when the president says we might have some flexibility here, well, that reduces the probability, by the way, of both. Because remember, the Fed thinks it's restrictive, and so they have a kind of predilection to be cutting.
So, my opinion here is I disagree with Steve in a huge respect that could send you down a really bad path. Listen, do not try to predict what the Fed's going to do or whether they care more about inflation or recession or anything like that, right? Make your investment decisions based upon companies that you believe are going to do great over the next 3, 5, 7 years, regardless of if the Federal Reserve lowers a quarter basis point next meeting or 50 basis points or they don't, or recession, blah, blah, blah. Like, focus on, like, every company I'm investing into right now are all companies that I believe are going to do great over the next 3, 5, 7 years, regardless of what the Federal Reserve does at their next meeting or the next meeting, or what Trump does with tariffs or blah, blah, blah. Okay? And so that's how you got to think about making your investment decisions, not try to predict what, the Fed's going to do or not going to do. Because, that's just a lost game. And the Fed doesn't even know what they're going to do. Like, the Fed can change, in a matter of a few weeks, their opinion on, if they want to raise rates, lower rates, all that stuff.
If they can get a kind of all clear from all the dust that's been kicked up by all the policy changes.
Yeah, points well made. We've leaned on your expertise a lot this week, Steve. I appreciate you being with us. That's our senior economics correspondent,
Pleasure.
Steve Leisman. Let's bring in now Cameron Dawson of New Edge Wealth into the conversation. So what's your current take on where we are in this, I say, still unsettled and obviously uncertain market?
I think we have to make a distinction between a correction that is more about valuations and positioning, which tends to be shorter and shallower, tends to average around 10%, and a correction that has growth fears to it. And that is the big open question, is that we've started seeing GDP estimates come down slightly. We've seen EPS estimates get cut effectively for the last 6 months. How much more downside is there to those two estimates? If there is more downside, then we should be prepared for more volatility, potentially more chop in this market.
So if we were at more than 22 times for the S&P before this whole thing happened, right? The unwind and the correction of some 10%. Now we're a little less than 21. Let's call it 20 and a half. If earnings estimates are coming down and uncertainty is going up, is that multiple still too rich?
I do think so, that if we're continuously cutting earnings estimates, you typically get a double whammy. When you're cutting earnings, you also are derating the multiple, because that comes with a risk-off tone and a risk-off flavor in the market. Now, do we need to see estimates come down more than what they have? That is an interesting question, because estimates still do have us going to record margins this year, meaning that there's still an implicit idea that we're going to see more productivity, we're going to see good top-line revenue growth. Do tariffs call that into question if companies have trouble, for example, passing on price increases onto their customers?
Let me ask you, how can you make the case, if you in fact are?
Before we go further here, his way of thinking there about, the market 22 times right now, or 20.5, whatever, right? Here's another way to think about this. I think it's a better way to think about this. Where do you put your money? Okay, let's say, you know what? I don't feel comfortable putting in the stock market. Okay, where are you going to put it from there? Well, let's see your options. You have savings accounts, which continue to yield goes lower and lower, right? CD accounts, same exact thing, right? A lot of CD accounts are now starting, even the higher yield ones are starting to yield more in like the 4% range. We know treasuries have been in a downward move, for this last bit of time. So, okay, not super attractive like it might have been, a year ago or so. Then you can say, okay, real estate. You want to buy real estate right now? I don't know about that, right? A lot of people do not feel comfortable buying real estate right now. So you can say, okay, gold. Gold's at all-time highs. You want to buy gold right now at all-time highs? Okay. Right? Where's your next option? Bitcoin? Okay. We know Bitcoin comes with a lot of risk. If you're scared about recession and market getting hit, Lord knows what Bitcoin does when the market goes down, right? It's basically like a put option on the market, right? Like, this is as simple as that. When the Nasdaq tanks, Bitcoin tanks way more. We've seen that story play out time and time again. Look back to 2022, the most latest example, right? And so, where do you put your money? Or would you rather buy Meta stock at a forward P of 22 or 23 or whatever? Or Amazon? Gosh, I would rather put my money in Meta stock. I would rather put my money in Amazon, because guess what? I think those are going to perform a lot better over the next many years, regardless of whatever drama happens out there, than many of these other assets. So that's another way to think about it that I think is a better way to think about it, at least in my opinion.
That the market at this level is fairly priced.
Well, I'd argue there's a tariff discount on markets. In our surveys of clients, for 3 months now, they've cited Trump tariffs as the number one policy risk. Then deportations and Doge, more than Fed error. Once we get a tariff resolution, that discount should come off the market. I think that's multiple expanding. It's no different than saying you're taking away one of the biggest tail events for markets.
One of your big calls to me feels like, and it almost supersedes any bit of negativity, is the Fed put, which you make the argument continually that it is alive and well, and that we got more evidence of that this week. So you're almost protected, even if there's some level of downside from here in the economy.
Yes, I think the Fed put is still alive and well. We got a reminder this past week. And as Steve says, the Fed is marginally more worried about growth, which means that the moving from tight to neutral to easy would be not many titrations. And there is still going to be a Trump put. I think once the tariffs are behind us, there is going to be an interest in Washington to sort of make sure the economy doesn't unravel, which means the Trump put is back in play after April 2nd. And of course, there's a sovereign wealth put coming as well. So I think markets have multi-dimensional downside in addition to all the cash that's been raised and the negative sentiment. So I think this is all multiple expanding.
Well, in another huge thing I don't think a lot of people think about is two parts. This is massive. If you want to be bullish, I'll give you two reasons to be very bullish over the next few years, okay? One, taxes. There's a pretty good probability that Trump will go down in regards to, and will be able to bring down corporate taxes, at least a little bit. You may say, well, what does that matter to me? Well, if you own stocks, that matters to you. If he can bring down corporate tax, even a percent or a few percent, it helps massively. I think there's a decent probability personal taxes could come down as well. That benefits everybody, right? If that does play out, right? So, if you want to be bullish about something, I think that's something to be bullish about. Second part is the Federal Reserve has had handcuffs on the economy for 2.5 years now. If the Federal Reserve is in a lowering cycle, which they are, and interest rates are going to trend lower over the next year, next couple of years, well, that's going to help out the economy. People are going to be able to get auto loans easier and home loans easier, right? And be able to pay less money in interest, and all that benefits, right? Corporations are able to take out debt easier, able to take out debt cheaper. All that stuff matters substantially. And then if you want a third part, I can give you a third part. What happens when all this insanely negative sentiment from investors, from consumers, what happens when it starts to go the other way and it starts to get a little more positive? And it's like, oh, it's not as scary as I thought. Oh, it's a little more. Everybody just wants to get wrapped up in the bearish case right now, and the glass half empty. We can always look at the glass half full and remember. And I feel like that's part of my job, is to always give you guys, what could go wrong in a good environment and what could go right in a bad environment, right? But remember, it wasn't that long ago, it was 3 months ago, that people couldn't see anything bad happening, right? It was only green shoots. It was only positive. And then look how fast it shifted. You think we can't shift the other way over the next 3-6 months? Oh, yes, we can.
There's still a degree of a so-called Trump put. Why then does it feel like the administration is going out of its way in certain instances to almost telegraph, if not a recession, a bigger slowdown than we're going to have now, making the argument that it's worth it for the policies that we're putting in?
Well,
haven't they done that? I mean, Treasury Secretary on this network talked about needing a detox. And he's not the only one who has made comments of the like. The president himself has not gone out of his way to say we're not going to have a recession.
Yeah, well, I think it's appropriate for the administration to set expectations, and I think it's very inconvenient for markets to be their focus in the middle of the tariff negotiation. It's the hallmark of his policy, but I think once that's behind us, I can't imagine an administration that wants us to have a recession. I mean, a detox is one thing, and it's a shift from public sector to private. But that handoff, as you know, they've even backpedaled. They actually want that to be as smooth as possible.
And you're assuming that they can manage it in that way, just like we assume that the Fed can manage it on its own side. It doesn't really matter what you say or what you think. Can you actually do it when the you-know-what starts to hit the fan? Do you believe that the Trump put, that the Fed put exists?
2018 is a really good reminder that even though we had an eventual Fed put, we were down 20% from peak to trough in that December trading, even though you did see the Fed eventually step in and reverse policy. So just because the put exists doesn't mean the strike price is where it is today. We do think that you would need to see more volatility for them to actually back off on any policies that could be volatility inducing.
What do I want to do then right now in the market? What do I want to do? Do I think this too shall pass, and then the broadening story is going to pick right back?
Let me talk about something important, because you brought up 2018. Where do I rank right now in regards to the best buying opportunities I've seen over the last, we can call it 10 years. Let's go back to 2015. Okay. I would say the best buying opportunity, there's been a few. One of the best buying opportunities I witnessed actually was that late 2018 one. And the reason being is the market was getting wrecked at that time. Like, stocks were just getting hammered, and it made no sense, at least in my personal opinion. I was looking out there and I'm like, things don't feel that bad. Things aren't that bad. I think 2019 sets up for a good year for the markets and for stocks. Like it was silly. And the market was just taking a pounding. That was an incredible buying opportunity. I would put that as number 2 best buying opportunity I remember in the last 10 years. Rona was definitely a great buying opportunity, but it was a scary buying opportunity. That's why I don't rank that number 1. The number 1 I would rank as the 2022 drop. The 2022 drop was, man, what an opportunity. I mean, we were getting the best tech companies in the world at 60, 50, 70, 80% discounts. That was the best buying opportunity I've witnessed in terms of just being like a clean buying opportunity. It wasn't like, the Rona one, once again, was scary because we weren't sure if they were going to actually close the economy for 3 years and all the stuff that was talked about at that time. 2022 was like, okay, inflation's high, but it's coming down. The Fed's working against the market. Yeah, but that's going to eventually end and, we'll make it through. But you were looking at the greatest companies in the world at 50 and 60 and 70 and 80% discounts. And it's just a ridiculous buying opportunity. And this is a very good buying opportunity. Not to that 2022 level, no. Not to that 2018 level, no. We would need to get hit another, I would say, 7 to 10% in the S&P to get to that like 2018 range. If we could get hit another 7, 10%, then I would, that would be a level that I would have to get out there and like really go really low on cash levels like I did in 2018 and like I did in 2022, right? Right now, I'm not that low. Like, I'm deploying money. I'm deploying good amounts of money. I covered that on the main channel here today. But it's not getting down to that, like, we're critically low on cash. When I get down on that level, it's like a multi-year historic buying opportunity.
Again, there's just too much uncertainty for a lot of economically sensitive things to work. What's your advice now?
I think that you have to have a 2 to 3 year forward outlook to be buying weakness today. If you're buying weakness and expecting a V-shaped recovery, we don't think you're going to get it. That's very different than 23 and 24. 23, 24, every time you had weakness, you had a very sharp recovery and made new highs soon after. We think that there's a big potential that, yes, you can buy weakness, the forward returns start to look better, but be prepared that it's going to remain choppy before we eventually get to new highs, which could take some time.
I want you guys to debate this for a minute. I go from 3 to 4 year outlook to what sounds to me from you like 3 to 4 weeks.
Want to debate? I could not think of 2 worse people to have tried to get in a debate than Tom Lee and Cam. Like, these 2 are the least confrontational people you could have possibly had on there. Get Steve Weish on there, Mr. Short Hills Capital, okay? Get him and Joe Terranova. Those 2 will debate it out and fight and argue, right? These 2 are the least confrontational probably people they ever have come on CNBC, honestly.
Well, I mean, I'd say if we look at history, when you look at drawdowns from a 52-week high, and this is the 5th fastest in 75 years, if you take the 6 precedent declines, they were all V-shaped recoveries. So the speed of the decline had a symmetric recovery. I think almost everyone I talk to is so defensively positioned, and so many have lost hope that they're in Cameron's camp that it's a L-shaped bounce. Every time everyone says it's an L-shaped bounce, it's always been V-shaped. So I'm in the camp it's a V-shaped bounce.
You know what's funny? I wouldn't be surprised if Tom Lee ends up being right on this, right? Don't bet on it, don't guarantee it, but man, I wouldn't be surprised at all. And I've stated many times, like, this year reminds me a lot of what year? 2018. 2018, we had a heavy sell-off beginning of the year, right? And then we had a massive recovery in the spring and the summertime. And guess what? If I remember correctly, we just started spring, did we not, right? We had a massive rally in the spring and into the summer. And then in the fall time, that's when you had that vicious fall for the stock market. So I wouldn't be surprised at all if we went, April 2nd comes around, the market already starts going risk on before April 2nd. April 2nd comes around, everybody's like, oh, and then it's like, oh, it's not that scary. And then it's like, oh, boom, blast higher, right? Don't bet on it, but don't be surprised if that's the way it plays out. I would not be surprised whatsoever. And then you go risk on for, many months, and then, we'll see what happens with all this drama and does it actually affect the economy or not. But that takes time to play out.
Good market historian, that lady to your left. What do you think about what he said?
So the counter to that would be that we have been seeing fading momentum for the last year. Look at a weekly MACD. You've seen momentum start to fade. So if we're trying to run through this wall of overhead resistance, which we think we're going to hit around 5,900, you're not doing it at full speed because momentum has been fading for so much time. So we think that we will judge the bounce by the time that we hit that overhead resistance. If we start to roll over, then we think that you could potentially retest the prior lows that we got to on March 13th.
Yeah, and maybe just another data point to add. I think we should just watch Tesla. If Tesla has an L-shaped bounce, then the market's bounce will be L-shaped. But if Tesla bounces from 220 back to some major retracement, then it's a V-shaped bounce.
So I disagree with Tom Lee on that. I would not look to Tesla. Traditionally, 100% look to Tesla. I think we're in a different time in regards to Tesla. I would not look to Tesla anymore now at this point in time. It's gotten too rough in regards to Tesla to look at Tesla as a gauge on what's going on out there. No. Okay. Now, why do you get a V-shaped recovery? I think this is a fair subject. Why does it happen so often that we see this massive V-shaped recovery? Go back to 2022. Coming out of 2022, what do we see? Massive V-shaped recovery. Go to 2020. Massive V-shaped recovery coming out of the Rona crash, right? Go to 2018. And 2018, first, the beginning of 2018 had a big fall, V-shaped recovery, massive downfall of the market, V-shaped recovery, right? Why do we see these V-shaped recoveries time and time again? I'll explain exactly why. The market, especially the reason, the way it's programmed nowadays with algorithms, it sells off incredibly heavy. News travels faster than ever. It's easier to scare people more quickly than it's ever been before. So, you had this massive downdraft in the market, which is then followed by everybody that wanted to sell, sold. They all got freaked out, right? Then when you have the buying pressure return to the stock market, it's very immense, because then all of a sudden you have everybody and their grandma wants to start buying stocks again, right? Boom, boom, boom. Everybody wants to buy. You have very limited to low selling pressure. And what does that mean? Stocks go absolutely beast mode. And you see an absolutely incredible rally. And so, that's why all this happens. That's why you see these V-shaped recoveries.
We'll leave it there. Cameron and Tom.
Alrighty, so that covers Tom Lee there in my reaction to it. I hope you guys enjoyed that big piece there. I appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed. Additionally, if you're looking to apply to join my private stock group, get access to all my course curriculums, access to my proprietary software I use each day called 1000xstocks.com, all that good stuff, Discord chat access, see the stocks I'm buying, selling. That'll be pinned comment down there. Click on that, fill out a form, see if we can get you access next week. Much love and have a great day.